Johnson & Johnson is a stock in my portfolio that I have been buying over the last few years. However, in today's episode, we're going to take a look at whether the growth is too slow and maybe it should be one that should be sold or on hold, or even if it is undervalued at these prices to continue to add. We're going to take a look at the historical performance of this company. As always, we'll look at their latest earnings, we'll look at their top line revenue growth as well as their bottom line net income. We'll have a quick look at their balance sheet, their total cash versus their total debt. We'll see how well they've been performing or how poorly they've been performing versus the industry over the last few years. We'll look to the institutions to see whether or not they are still adding this company quarter on quarter. We'll talk about some insider selling that we've noted, nearly $10 million worth, and we'll discuss their dividend safety as well as their supporting financial metrics, and we'll run through whether or not, based on this article, it discuss a few topics, Johnson & Johnson is still a buy now. And as always, we will run it through the valuation model to get to the intrinsic value as well as the acceptable buy price, given our investor margin of safety, and we'll look towards Wall Street to see whether or not they believe there are some nice upside with this company over the next few years, and I'll give my thoughts moving forwards. So starting off with the historical performance, we can see over the last year they are down 4%. They are trading in fact in the mid to lower end of the 52-week range with a yield of just over 3%, a forward PE of just under 15, and over the last 10 years they are up 71%, although this doesn't include those dividends reinvested, and we can see they have hit their all-time highs a few times over the last few years at just over $180. So in terms of the top line, we want to normally look for 3 to 7% year on year as a minimum. And we do note the spin-off with Johnson & Johnson with Kenvue. So whilst this may not be the most accurate, we'll still just have a very quick look. So their top line did go from $82 billion in 2019 to 2023, $85 billion. So over the last 5 years, we can see it has increased, although we do also note that there was some portion of that top line removed by Kenvue. Although we do note this was around 15 billion. In the latest year, we can see 85 billion. So if we were to put that back in at around 100 billion, we would note growth over the longer term. In terms of the bottom line net income, then we can see 15 billion in 2019. And even after split, we know a large increase from 2023 at 35 billion. So both top line and bottom line are increasing, which is a good sign. We'll look at some further metrics in the analysis as well. In terms of the total cash versus total debt, 19.9 billion in 2019, 23.5 billion from their latest report. So they do hold a fair amount on their balance sheet in cash and short-term investments. And when we compare this to their total debt numerically and directionally, we know it's gone from around 29 billion to 30 billion. So it has increased slightly. And we do note that Johnson & Johnson alongside Microsoft has the best rated balance sheet at a AA. In terms of their performance then, a total return versus some of their competitors in the pharmaceutical industry, we have Merck & Co., AstraZeneca, Pfizer, a lot of well-known name companies. Over the last year, Johnson & Johnson down 1%. As we mentioned, it hasn't had the greatest of return. Bear in mind, this includes those dividends reinvested. Over the last 5 years, up 34% or just under, the middle performing of the industry. But as we note, the last 5 years, that isn't really a return on investment that you want to be targeting. But again, very important, past performance is an indicator of future performance. Now, institutional ownership sits around 68%, 26 billion worth of sales by these institutions over the last 12 months. However, nearly double or a lot more, in fact, at 41 billion over the same period. Now, over the last year, we note Q1, Q2 and Q4 where more buying was performed than selling, although we can see Q3 there was a large sale of around 30 billion. Overall, though, the institutions do like Johnson & Johnson, they are buying more than they're selling, and the more recent quarter, we also see that fact as well. Always remember, though, do your own due diligence. In terms of insider buying and selling, we've got a quick look through the screener, and we note that Jennifer Tauber, the Essential Vice President and Chair in the pharmaceuticals industry, sold just under 60,000 shares at a cost of just under $10 million. Now, remember what we say, essentially, it's not that bearish when insiders sell due to the fact that there are many reasons why, whether it's personal or financial. What we'd like to see is bullish signals and bearish signals. Unfortunately, I wouldn't say that this is a bearish signal, but we always want to be transparent to show whether there are any insider buys or sells. And it's also important to note that with insider buying, we see this as bullish, as Peter Lynch says quite clearly as well, that insiders only buy for one reason, and that is because they believe the share price will rise. Speaking about insider buys and sells, we did release our free weekly newsletter, the latest edition, running through companies over the last few weeks where there has been a ton of insider buying, a ton of insider selling. If you want to grab a copy completely free, click on that pinned comment below. We also run through our 7 golden dividend metrics on how to identify undervalued companies. So before we jump into the dividend safety, look at the financial metrics of Johnson & Johnson, we can run through just a few points from this latest Motley Fool article in February as to whether or not they do see Johnson & Johnson as a buy now. So one of the first things they do discuss is that they do have a rock solid dividend stock. They are a dividend king. They have been paying those dividends for the last 62 years consecutively, which we'll touch upon shortly. And in fact, they have a AAA credit rating. I did say AA, in fact it's AAA, and it's higher than even the US government. So a very, very strong rating there. In terms of their past performance as well, we can see that it is looking very positive, although we do note that they did take a hit to the earnings per share, and you will be aware that this is due to the charge for settling their talcum powder lawsuits. However, when you strip that out and you adjust that, the EPS in 2023 grew double digits, 11.1%. So lots of positives to note there. And in terms of the final point here, what are you exactly getting for your money right now if you were to buy Johnson & Johnson? Well, you would be buying it at under 15 times their 2024 guidance, and that yield at 3% is very, very consistent. We're going to touch upon that as well. Over the last few years, then what you have been getting around this stock would be around 10% total return, which includes their earnings growth as well as that dividend. So let's take a look at the dividend safety score, 99, very safe, market cap 380 billion, mega cap company. In terms of the key recessionary metrics, well, they increased the dividend during the last recession. They had above average growth, -6% versus -12%, and they significantly outperformed the S&P, -27 versus the S&P's -55. Dividend growth, well, positive 5.3% last April. That is above the 4% we advocate on the channel to get higher than just to beat inflation. And over the last 5 years, 6%, last 20 years, 8%, looking very strong for this consistent dividend king. And as we mentioned earlier, they have been increasing those dividends for many, many years. And in fact, they've been paying the dividend without a reduction for over 108 years. In terms of dividend yield theory, well, it states the company is undervalued when the current yield sits above the 5-year average, 3.04 versus 2.69. Another sign here of undervaluation, 14.6 on the forward PE versus the 5-year average of 16.4. Do bear in mind that we don't look at any of these models in isolation. We will conclude towards the end. Healthcare sector PE slightly higher, 17.3 versus JNJ 14.7. Now, in terms of the free cash flow payout, we focus on the free cash flow as the earnings is susceptible to manipulation by management through accounting. My personal blanket rule is below 60%. It is in the free weekly newsletter where I discuss that below 60% gives me faith that management are able to essentially offer those double-digit dividend increases we love to see. 2023, 76%, a little bit too high for my liking, but nice to note in 2024 it's expected to drop down to 48%. Free cash flow per share, it does increase 533 to 655, but it is a little bit too slow. We would like to see at least faster increases and at a lot more consistent rate. Do note that 2023 is expected to drop to 609, 2024 on the other hand to go much, much higher, which is always positive to note. Sales growth then, 2023, -10%. Again, that Kenvue spin-off did affect that top line. Before that, though, we do see around that 3 to 7%. But we also do see some years where it is pretty flat, 2019, 2020, and 2022 to note. In terms of numericals then, 74 billion to 85. Shares outstanding, they do return excess cash to investor pockets, 2.86 billion to 2.56. Nice to note they bought back around 300 million worth of shares over the 10-year period. ROIC, again, one of my 7 golden dividend metrics, one of my newsletter articles. 10% or more, one way to analyze management, or one part, in fact, that essentially they are able to effectively allocate their capital. The last 3 years in the low 20s is a nice strong side. Nice that it's above 10% and nice the consistency. Nice operating margin above the minimum is very consistent, in fact, over the last 10 years. Very similar on the free cash flow margin, although we do see it drop to 16% in 2023. Probably something just to keep an eye on moving forwards, that it has decreased, but overall nothing negative to note. We can see here the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, showing us the dividend safety as well as balance sheet strength. What we can see here, 0.22 in 2023, 0.2 expected in 2024. No worries there. It would take them 0.2 years to pay off all of their debt net of cash on hand. We can see their perfect AAA rating of their balance sheet strength, and no worries or anything to flag on that matter. So let's jump into the valuation. As always, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So let's jump into the first model that we're using, which is the multiples valuation model. We have companies in a similar sector and size. Their average P multiplied by that of the EPS of JNJ to get an intrinsic value 167 above the market value. So we have our first sign of undervaluation. We then move on to the dividend discount model. Now we see pretty consistent growth, 5.75 in fact over the last few years. Forward looking, we've gone a bit more conservative, slightly lower at 5.25 to get an undervaluation signal here with the intrinsic value of 182. We then move on to the DCF model with the free cash flows year on year. Forward looking, we've gone lower than analyst estimates at 7%. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we can see there another sign of undervaluation. So in today's episode for Johnson & Johnson, the intrinsic value is the average of these three models, and it gets to $180. Now with a current price of $156, we always start off with a margin of safety of 10%, and we use that if we believe it meets the three criteria: wide moat, strong financial metrics, good forward-looking data. So a margin of safety of 10%, we can see an acceptable buy up to 162. At 15%, it isn't quite there yet, but so we say there's between 10 to 15% margin of safety based on our estimates and judgments. In terms of Wall Street, over the next 12 months, they see the share price to go up to 178 with a price target and upside of 14%. Now, personally, this is one that I do hold in my portfolio. As I mentioned, this is one that I was buying a fair amount over the last few years. However, this is one that as of today, I will not be buying anymore just yet. In terms of the growth over the next few years, I will need to see a lot more from Johnson & Johnson before I can start adding. Or alternatively, I would need to see a much higher margin of safety. Preferably, I would like to see around 20 to 25%. So if we see it around $140, around that mark, that is when I will add it to the watch list and potentially start to add more. As we can see, that is pretty much right there at that 52-week low. Until that point, right now at the current trading price, this isn't one that I personally will be adding. There are other stronger opportunities for much higher growth over the next few years. As always though, let me know your thoughts in the comments below. Is Johnson & Johnson one you are adding at this price? Are you waiting for a lower price, or maybe just the growth overall isn't one that suits your portfolio? As always, have a great day. If you enjoyed today's episode, smash that like button, and as always, we'll see you on the next one.